Hello, how is everyone doing today? Welcome back to the Banker Next Door. I am your host, Dr. Joe Berquist. I am still smarting from my you can see here my Phils getting a win here over the weekend over the Braves. So still hanging strong in the playoffs. So hopefully that will continue, but we'll see. So I have kind of a special episode here today. I wanted to talk about unrealized losses in bank bond portfolios. This is a major topic of discussion in the banking industry right now, and something that I felt needed its own individual episode. So I want to share with you. I want to basically bring you up to speed, give you the history, the background on what's going on here. Why is this such a big issue for banks? I'm going to share a few things with you today, and then kind of get you on to where we're at in the bond market itself and what the effect is on banks, and basically what you can expect to happen with banks through the rest of the year and probably into early next year because of this. So, all right. So the first thing I want to do is I want to take you back in time here a little bit. So let's go back to the third and fourth quarters of last year of 2022. I've brought up here an article that was it was first published in March 13th of this year, at a very critical time. If you recall, that's right when we had 3 or 4 bank failures that basically hit the bank market literally right at that time in March and into April of this year. Which caused a lot of big brouhaha. We had, Signature Bank, Silicon Valley Bank, Silvergate Bank, and then First Republic Bank, California and New York, basically some of these bigger banks that basically went under, causing, big thing. A big part of the reason why those banks went under was because they had what was called unrealized losses on their bank bond portfolios. What does that mean? So on a bank bond portfolio, you have what's called HTM, which is assets that are held to maturity. And then you also have assets that are labeled as AFS, assets for sale. So assets for sale are things that you have for sale right this minute. An HTM bond would be something that you're holding to maturity, and maturity could be in a year, could be in 2 years, could be in 5 years. It just all depends on that particular bond and what you selected. Now, the interesting thing about it is the HTM, if you may have paper losses right now, meaning that if I were to go sell that security right now today, I would sustain a loss on it. But if I hold that security until maturity, I will actually make money on it. Now, we'll get into the kind of some of the technicalities here in a minute, but I wanted to share this article because this article hit, no, I'm sorry, this isn't an article. This is a paper. This was a paper called Monetary Tightening and U.S. Bank Fragility in 2023, Mark-to-Market Losses and Uninsured Depositor Runs. And this article was just updated on September 28th. And I want to read this to you because it's so incredibly important, and you'll see why this is so powerful here in a minute. So basically in the analysis in the study, they mark-to-market losses on bank assets due to interest rate increases from Q1 2022 to Q1 2023. Asset values declined on average by 10%, and the 2.2 trillion aggregate decline was on the order of aggregate bank capital. We present a model of solvency runs, which illustrates that interest rate increases can lead to self-fulfilling solvency bank runs even when banks' assets are fully liquid. The model identifies banks with asset losses, low capital, and critically high uninsured leverage as being most fragile. A case study of the recently failed Silicon Valley Bank confirms the model insights. 10% of banks, let me say that again, 10% of banks have larger unrecognized losses and lower capital than SVB. On the other hand, SVB had a disproportional share of uninsured funding. Only 1% of banks had a higher uninsured leverage on their deposits. Combined, losses and uninsured leverage provided incentives for an SVB uninsured depositor run. We compute new empirical measures of bank fragility for the sample of all U.S. banks, even if only half of uninsured deposits had decided to withdraw. Almost 190 banks with assets of 300 billion are at a potential risk of insolvency, meaning that the mark-to-market value of their remaining assets after these withdrawals would be insufficient to repay all insured deposits. So this article, I highly recommend people go out and take a look at this and read this article and review it. It's an incredible article, incredible write-up. So as I go back here, take a step back again, go back to 2022. So what happened? Well, the bond market had probably its worst year in 50 years. And you'd have to go back to the early 70s to find a worse year in the bond market in 2022. That is what led to all these, basically what led to all these unrealized losses in the bank's bond portfolios. Now, as we'll see in a minute here, as I get into some of these articles, these losses, they put a tremendous amount of strain on banks' capital and on their liquidity positions. So let's go in here now let's take a step forward. So things I will say, after we had a couple of these bank failures, things over the summertime really kind of stabilized for a little bit. But now as we've gotten back into September here and now into October, this issue is beginning to rear its ugly head as the bond market has taken a serious turn downward. So let's look at our next thing here. This was an article that just came out on October 6th, which was just a couple days ago. So, and this is from Investopedia. We're in the biggest treasury bond bear market ever. I gotta say it again. We're in the biggest treasury bond bear market ever, according to Bank of America. So government bonds have shed a quarter of their value since 2020, the steepest decline in history. So as we page down here, I just wanted to read a little bit here. So the market for U.S. Treasuries has shed almost a quarter of its value since Treasury yield bottomed out in the summer of 2020. It's the biggest Treasury bear market in history, surpassing two similar periods in the 19th century, according to Bank of America research note. That may be the biggest bear market for U.S. Treasury bonds of all time, analysts at Bank of America wrote in a research note on Friday. The market for U.S. Treasuries has shed almost a quarter, 24.7% of its value since Treasury yields bottomed out in the summer of 2020. Pretty amazing. Some of the biggest bond market ETFs that track the price of Treasury bonds have been pummeled amid surging yields, with those exposed to longer duration Treasuries recording the steepest losses. So we're in this very bad bear market now. And how is this affecting banks? Well, let's take a look here. So this is an article from S&P Global Market Research. Higher for longer rates mean lingering pain for bond portfolios. So, and look at this chart here. And I just want to read you this piece at the top here. So as banks gain more clarity about the direction of interest rates, more institutions could contemplate securities portfolio restructurings, allowing banks to alleviate one of the headwinds to their margins. However, with more increases in interest rates pushing bond portfolios further underwater, many banks do not have enough regulatory capital to withstand the hit from losses on security sales, which will limit future activity. Underwater bond portfolios are also negatively impacting liquidity ratings during regulatory exams as regulatory focus on banks' contingent liquidity planning. And again, I think this chart here, as you can see, this says it all. So for our podcast audience, what we're looking at a chart of net unrealized gains or losses at U.S. public banks. So net unrealized gains or losses, you can see the blue chart here, basically since the first quarter of 2022, this has gone negative, and it has been dramatically negative. Implied is the orange line here. Implied unrealized gains or losses in HTM securities. Again, in the article that the research study that I showed you at the beginning, basically makes a case that there could be, they're saying unrealized losses are around 600 billion, but they're making a case that it could be as high as 2.2 trillion. Obviously, this is a dramatic problem for banks now. What happens here? So let me paint you a picture. So even though the bank has not actually realized the losses here, what happens is bank regulators come in and they say, you have a liquidity problem, because the idea here is that if a bank gets into a crunch, if they get into some kind of liquidity crunch where they end up with problems and they need money fast, what the idea is, in their investment for portfolios, these are liquid assets that they could divest themselves of in, say, 24-hour, 48-hour, 72-hour period and get the cash for that. But the problem here is that if they did that, they would take huge losses on that, which hurts their liquidity, which means they got to go to other areas for liquidity. This can also dramatically impact the bank's capital. So what's happening there is, even though the banks have not actually realized these losses, the regulators are coming in and saying, hey, man, this is a big problem, and we're going to downgrade you. And obviously, the banks don't want to be downgraded, because if you're publicly traded, you come in, you get downgraded, and you say, well, yeah, we've got these problems in our bank bond portfolio, and you get downgraded. What's going to happen to your stock? Your stock's going to go down. What's going to happen with some of your customers and your clients? Well, they're going to start asking questions. They're going to start saying, hey, what's going on here? Is this a problem? Is this something we should be worried about? I mean, we saw these bank failures earlier this year. Banks don't want to answer those. They don't want to basically be put in this position. They have to answer those questions. And then let's go down here. Let's take another look, because there's just one other chart here. So you can see, this is a chart here, HTM securities trends at U.S. banks. And you can see the purple line at the top here. Basically, this is HTM securities, total securities for banks above 700 billion in total assets. You can see that HTM number is dramatically increasing. It started increasing in the first quarter of 2022. Again, a little bit of this is, I think, what you would have to call kind of like smoke and mirrors. I think that some banks out there are, looking at, okay, how can we kind of massage this a little bit, so to speak? And I think that you're seeing that some of these bonds have been, shifted from assets for sale, AFS, to held to maturity, so that, again, they didn't have to realize those losses at the moment. Now, again, some banks are being very proactive in this and basically saying, hey, we're just gonna take the hit and keep on rolling here. For example, the one article here goes on to say, City National Bank, out in Los Angeles. I mean, basically, they sold a bunch of bonds below cost, and they took the hit before matters got worse, as according to them. Tompkins Financial, basically, they were expected to log a third quarter net loss after selling securities at a loss. So basically, they repositioned their balance sheet in September through the sale of about $429 million of available for sale securities for an after-tax loss of about $47.5 million. And so I think that was smart. I think that was actually really smart on their part. I think any bank that's looking at this right now and trying to figure out what to do, I think they got to take action on this. I don't think they can sit on this. And I think that's where this is all going, is that, we're in this bear market in bonds. And I want to just a couple more things here I just wanted to share with you real quick. So again, I mean, what is this causing? Here's another article here. U.S. banks shrink, wary of risk and paying up for growth. So in other words, the bank's bond portfolios, they're getting pressed. Liquidity and capital is getting pressed, and as a result of that, banks are now shrinking their balance sheets, because they're looking at loan to deposit ratios. They're looking at facing potential delinquencies in commercial real estate and other things, and they're basically saying, hey, we need to pull this, we need to pull back, we need to kind of rein it in, shrink the balance sheet a little bit, make sure that we have plenty of liquidity and capital on hand. They want to check their uninsured deposits, make sure that they're not too out of whack with that, and that hopefully they can deal with anything that came in. But just to the industry reported 23.465 trillion in total assets in the second quarter, the lowest aggregate level since the third quarter of 2021. Since the start of 2022, the industry as a whole has posted quarter over quarter declines in total assets in 4 of the 6 quarters. Well, again, it's because of what's happening here. So, and then last couple articles, when will the Fed stop raising interest rates? That's the $1 trillion question for bond investors. So relentless losses in the bond market have spooked investors who appear hesitant to jump in until they feel more confident that rates have peaked. Investors pulled $78.6 billion from U.S.-based taxable bond funds in the 12 months through August, according to what I read. It doesn't say, but anyway, that is well below the near $300 billion they pulled from equities over the same period, but a painful sum regardless for asset managers that were hoping for a windfall in bonds instead of. Investors remain wary of continuing Fed rate hikes. Bond prices and yields move inversely. So the Federal Reserve's aggregate interest rate campaign is behind both the steep decline in prices and the sharp climb in yields. It has created an opportunity for investors on 2 fronts. Yields are at their highest level in more than 15 years. And since bonds pay out their full par value at maturity, investors buying and holding to the end can expect price appreciation barring a default. So again, good for investors at the moment. I don't see people rushing in to buy bonds right now just because they're kind of like a falling knife. They're on sale and lower prices should create demand, but we're not seeing that as bond losses continue to accelerate over the past 2 weeks. And then finally, the last thing, rising rates likely to hit bank balance sheets in the quarter. A surge in interest rates likely worsened unrealized losses on bonds and loans held at U.S. banks in the third quarter, further straining their balance sheet as they face pressure to pay more to keep depositors. Unrealized losses were a key cause of the Silicon Valley Bank's failure in March, which spurred other bank runs. That risk has ebbed. However, total deposits at U.S. commercial banks were little changed since the end of the second quarter, according to the Federal Reserve's latest data, although they are down 5% since their peak level in April of 2022. Importantly, however, the industry has stanched deposit outflows for now. But they said, I expect unrealized losses to increase, said Alexander Yoakum, a banking analyst at the investment research firm CFRA. For us, solvency issues are less of a concern, but the amount of profitability is a concern. Higher yields cause debt prices to fall, reducing the value of trillions of dollars in fixed rate bonds and loans that banks hold, regardless of whether they intend to sell the assets. In some cases, the losses were equal to or greater than the bank's equity or the buffer they hold to absorb such hits. That led to a crisis that brought down 3 regional banks earlier this year. That's exactly the point I was talking about. U.S. banks' unrealized losses on investment securities were $558 billion as of June 30th, according to the Federal Deposit Insurance Corp. The unrealized losses were up from $516 billion 3 months earlier, but down from their peak of $690 billion at the end of last year's third quarter. I don't know that is accurate. They're saying that here. However, like I said, if we go back to the research study that we looked at, again, this has kind of gone in ebbs and flows. But if we go back again to this, if we go back again to what we just looked at here, and we go back up, does this look like it's? Does this chart look like it's getting better? Just a tad bit, but that still looks pretty ugly. Let's see here. So more than half of such losses each quarter were on bonds classified as held to maturity, and so do not include on banks' balance sheets under the accounting rules. At the end of 2021, unrealized losses were negligible system-wide, but that changed obviously in 2022. Part of the reason unrealized losses were down from last year is that banks have reduced their bond holdings, often letting them roll off as they have matured without reinvesting the proceeds into new debt securities. Banks' bond holdings as of June 30th were down 12% from a year earlier, according to FDIC data. In some instances, banks have elected to crystallize their losses by selling bonds below cost and taking the hit before matters got worse. The FDIC doesn't publish fair value data for loan losses. The only banks that are publicly traded are required to report on such data. So in other words, what they're saying is that the held to maturity assets don't necessarily have to be reported and are kind of held off of banks' balance sheets. However, I will say the FDIC more recently has asked banks to put a lot more information on the call reports as it relates to this unrealized losses in their bond portfolios in addition to uninsured deposits. So, where does this all go to kind of wrap this up? I mean, where does this all go at the end of the day? Well, this is obviously a major problem for banks. I think you have at least a couple. I would estimate. I mean, you have almost 4,700 banks in the United States right now. I would estimate that you probably have a couple hundred banks that have issues with this that we need to keep an eye on. This problem is not going to get any better in the short term. I mean, I see this definitely carrying into next year and continuing to impact banks' earnings. It's going to continue to cause the banking industry to consolidate. You're going to see assets continue to shrink. You're going to see banks' balance sheets continue to shrink, which means you're going to have a contraction in lending. They're not going to be as banks are not going to be as aggressive in lending. They're going to tighten a lot of their standards, which in the market update episode I just did, I just spoke to that. That is a trend that you're seeing, right now. And I think that a lot of banks would be very wise right now to do, what Tompkins and what I think National City Bank did, and that is, if it makes sense, bite the bullet, sell sell the bonds that are underwater right now, reposition your balance sheet, and just make sure you've got a lot of access to liquidity, whether it be through like a federal home loan bank line of credit, something of that nature. But definitely, this is definitely something to keep eyes on, because I think that this is going to get a little bit worse before it gets better. I don't see the bond market performing very well through the rest of this year. We'll have to, we'll keep an eye on it. Obviously, got a few more months to go here, and I will come back with more updates and let people know kind of what's going on with that. But definitely something we need to keep our eye on with this. And I would definitely suggest, again, going back to that article that I talked about, monetary tightening and U.S. bank fragility in 2023. It looks like they are continuing to update that. So I would keep an eye on that and see what they say. But definitely check that out. And so I hope people find this episode interesting and informative. I do see this as more of like a special episode, really kind of focusing in on this very special and timely topic at the moment in banking. But if you like what you saw today, please like, subscribe, share, take a like I said, don't forget to go to the website at thebankernextdoor.com. Check that out. Definitely check us out on Rumble, YouTube, and all major podcast platforms. Leave a comment if there was something, and if you like this analysis, if there was anything you thought I missed, please make sure to like please make sure to leave a comment and let me know what you think. And I'll be back again to talk to you guys real soon. Got a lot more topics coming up, all kinds of great things with cryptocurrency. Central bank digital currency, a lot of different things in the mix. So be back to you guys again real soon. Thanks a lot.